You buy insurance to stop one bad day from wrecking your life. But the company behind that promise is running a business you almost never see. One side is the umbrella promise. We'll pay if disaster hits. The other side is a giant piggy bank where money sits before it's needed. Insurance companies aren't just claim payers. They're a two-part machine. One part prices risk, and one part invests cash. They track a scoreboard called the combined ratio, like a simple money in versus money out grade. Below 100% means the insurance side made a profit. In 2024, the U.S. property casualty industry hit a combined ratio of 96.9%. Here's the weird part. That's like keeping about 3.1 cents from each premium dollar before investing even starts. Other years, the needle goes above 100%, meaning underwriting loses money. So how can insurers still survive and sometimes thrive? The secret word is float. Money collected now, but paid later. It's like holding a huge pile of lunch money before snack time. In 2024, U.S. P&C insurers wrote about $1.1 trillion in direct premiums, and the industry held nearly $9 trillion in invested assets. So the real question is, how does your premium turn into profit? Picture an insurance company like a car with two engines. One engine sells protection, and the other engine invests the cash. If premiums plus investment gains outweigh claims plus expenses, the company wins. But then the story flips because insurers get paid before they pay.
Most businesses pay costs first, then earn money later. Insurance is upside down. It collects money first, then the real bill arrives later. A single giant loss can be scary, but with a huge pool of customers, the average gets more predictable, like marbles evening out in a jar. Underwriting is the choosing and pricing job, like sorting players into teams before a game. They try to charge each customer a price that matches their risk. They use rules, data, and lots of tiny details to avoid bad guesses. When they guess wrong, the losses can snowball. Wait until you see the scoreboard insurers obsess over. The combined ratio rolls claims and expenses into one number that screams winning or losing. In 2024, the industry spent about 71.2 cents of each premium dollar on claims and 25.2 cents on expenses. That left roughly 3.6 cents as underwriting profit before investment income. Those leftover cents are nice, but time is the real ingredient. While claims wait, the premium money can earn more money. After claims and expenses, leftovers can go out as dividends or share buybacks to shareholders. In a mutual insurer, owned by policyholders like a co-op, some leftovers may be returned to customers as dividends. Getting into insurance isn't easy. Companies need licenses and must hold capital, like a big safety helmet. Those rules protect claim payments, and they also limit new competition. Now for the twist. Insurance can look like a defensible toll booth because you need permission, trust, and data to operate. Next, let's open engine number one, the underwriting engine.
When you buy a policy, you trade a sure small payment for a maybe huge bill. The insurer's job is to price that maybe without going broke. Some claims pay fast, like car accidents. People call these short tail. Others drag on for years, like certain liability claims, long tail, meaning a long wait to settle. Claims aren't only repair checks. They also include the claim handling costs, lawyers, adjusters, experts, called LAE, like paying the referees of the claim. In 2024, U.S. P&C insurers incurred over $558 billion in net losses, including those handling costs. That's why they're obsessed with being ready for the pile. So why does this matter to your wallet? Because every premium dollar gets sliced into buckets, and the slice sizes change when the world gets riskier. One bucket is selling the policy. Many agents earn commissions, often 10 to 15% of the premium. It's like paying a helper for guiding you through a complicated store. Another bucket is operations, underwriting teams, claims teams, and tech systems. An actuary is like a math weather forecaster who predicts future claim storms. Insurers try to cut costs with direct-to-consumer sales and faster claims tools, including AI. They're doing that because claims costs don't sit still. The expense ratio often hovers around 25 to 28%, so efficiency is a big deal. When the system wastes money, premiums often carry the weight. And this is where the math turns into a superpower. When profits look easy, companies fight for customers and prices can haul. This is a soft market.
After big losses, the mood flips. A hard market means higher premiums and stricter terms because fewer insurers want the risk. This up and down is the underwriting cycle. like a roller coaster powered by competition and fear. Cheap pricing can plant the seeds for the next painful swing. When inflation rises, repairs and rebuilding cost more than expected. That can squeeze insurers, especially if last year's premiums were set too low. In 2023, the U.S. P&C industry had a combined ratio of 101.7%, meaning underwriting lost money. Yet it still earned about $87.3 billion in net income after tax, thanks to investment gains. But there's a catch nobody tells you at checkout. An insurer can lose 1.7 cents per premium dollar in underwriting and still end the year positive if investments are strong. This isn't new. From 1978 to 2003, the U.S. P&C industry had no year of aggregate underwriting profit, and 2004's 98.1% combined ratio finally flipped it. Insurers also buy insurance for themselves, called reinsurance, basically a backup umbrella. They give up part of premiums so one disaster doesn't wipe them out. Reinsurers can be global giants like Swiss Re, Munich Re, SCOR, and syndicates at Lloyd's of London. They spread big shocks across many balance sheets worldwide. In 2023-2024, reinsurers pushed a hard deal, higher prices and higher attachment points, like raising the deductible before reinsurance pays. That means primary insurers retain more everyday losses. Keep watching, because one change upstream can hit your bill fast. When reinsurance gets costlier or pays later, insurers often raise premiums, deductibles, or tighten coverage. Big insurers can spread bad luck better than small ones. Scale can lower per-policy costs and smooth random losses. Regulators want a cushion, called surplus, so claims get paid even on ugly days. Think of surplus like spare pillows under a heavy shelf. Sometimes the most profitable move is saying no. In high catastrophe zones, insurers may non-renew customers to avoid tail risk, like a surprise monster bite at the end. In California, 7 of the 12 largest insurers stopped accepting new homeowner business in high-risk areas since 2022. When private coverage pulls back, more people get pushed into last resort pools. Here's the sneaky treasure chest hiding in plain sight. Float is the pile of premiums collected now that won't be paid out until later. Because money arrives before the bill, insurers invest in the meantime. It's like holding everyone's allowance between now and the day the snacks get bought. In long-tail lines, claims can take decades to settle. That long wait makes float deep, like a swimming pool instead of a puddle. To understand the investing side, you need one idea: interest. Interest is the fee you pay to borrow someone else's money, like renting a toy. Insurers mostly buy bonds, which are IOUs that pay interest over time. They like IOUs because claims arrive on a schedule, and IOUs can match that timing. But then, interest rates walk in and change everything. Average insurer portfolio yield rose from 2.58% in 2021 to 3.66% in 2024, making the same pile earn more. In 2024, P&C insurers earned about $85 billion in net investment income from interest and dividends. That money can cover underwriting mistakes or boost profits. A tiny percent on a gigantic pile becomes a huge number. At around 3.7% on a $9 trillion base, gross investment income can be roughly $333 billion a year. That's why investment gains can make up well over half of P&C net income in some recent years. Underwriting sets the rules, but investing can move the score. In 2017, the combined ratio hit 103.9%, and net income was only about $38.7 billion. Big loss years remind everyone, float isn't magic when claims explode. Ready for a surprise? In 2024, net income after tax was about $166.8 billion, nearly double 2023. Underwriting swung to a gain, and investment income surged. Insurers build a safety cushion called surplus, like extra batteries in a flashlight. U.S. P&C surplus grew from $706 billion in 2015 to $1.13 trillion by 2024. Most invested assets sit in bonds, about 60%, because boring reliability matters. The goal is simple: money that's there when claims show up. The rest spreads into things like mortgages, stocks, cash, and other investments. Different insurers mix these differently depending on how fast they expect claims to hit. Insurers try to match what they own to what they owe, called liability-driven investing. It's like packing the right snacks for a hike so you don't run out early. Now watch what happens when rates go up fast. New money can earn 5% plus, but older bonds bought around 2% can drop in market value.
Selling old bonds can lock in losses, so insurers may feel stuck. That lock-in can slow how quickly they change their portfolios. In long, low-rate years, some insurers reached for yield, chasing higher returns with riskier assets. It can lift profits, but it also raises the chance of nasty surprises. Private credit is one destination, loans that aren't traded openly, like lending on a quiet side street. Investors get an illiquidity premium, extra pay for money you can't quickly grab back. And this is where safe investing starts getting risky. Private placements reached about 14% of life insurers' general accounts, around $849 billion in 2024, locking up more money longer. Life insurers also hold lots of commercial mortgage loans, like lending against office buildings. If those values drop, the investing side can feel pressure at a bad moment. History shows what happens when investment risk gets too weird. In 2008, AIG nearly collapsed after writing credit default swaps, like insurance on loans, without adequate capital. After that, oversight tightened on insurers' non-traditional bets. It's a reminder that the investing engine can't run wild without rules. Modern insurers increasingly act like shadow banks because they manage huge pools and make lots of loans. Next, let's see the version of insurance that feels even more like banking. P&C insurance is about accidents and disasters that may happen soon. Life insurance and annuities run on long timelines, years and decades. Wait until you see how life insurance plays a totally different game. Annuities can act like a spread business, paying you a promised rate, then trying to earn more.
In one simple model, for every $1,000 deposited, about $950 gets set aside as a benefit reserve. That reserve is like a locked emergency jar for your future payout. Selling these products can be pricey. Some commissions are front-loaded, with 50 to 90% of the first year's premium paid to an agent or advisor. The right now profit can be tiny, sometimes around $10 for every $1,000 in this model. So the profit isn't made at the checkout counter. The real game is the spread, like borrowing cheap and lending higher. In this model, the insurer credits 3%, invests to earn 6.5%, and keeps a 3.5% spread per year. Here's the wild part. The profit may show up years later. Over a 10-year contract, that 3.5% spread can compound, stacking like building blocks. If yields fall, the spread can get squeezed, called spread compression. It's like pinching a straw so less soda can flow through. If rates rise elsewhere, customers may pull money out to chase better yields. Disintermediation. It's like kids leaving one snack stand for a better deal across the street. Insurers split money into general accounts and separate accounts. General account backs guaranteed promises, while separate accounts are where customers take most market ups and downs. In 2024, separate accounts totaled about $3.3 trillion. If markets fall, customers' account values can drop, while the insurer is mostly protected except for fees and guarantees. But there's a new kind of owner pushing the gas pedal. Private equity firms like Apollo, owning Athene, and KKR, owning Global Atlantic, have bought life insurers to access permanent float.
The play can look like a flywheel. Originate loans, sell them to the insurer, collect fees, repeat. The insurer earns spread, while the parent firm earns origination and management fees. Portfolios shift from public bonds toward private credit and asset-backed securities. That can raise returns, but it raises liquidity and credit risk. Harder to sell fast, and borrowers can default. Now let's talk about the monsters under the bed. Inflation is when prices grow like a giant balloon, and it can blow up claim costs. Insurance pricing is forward-looking. Today's premium aims at tomorrow's costs. If costs jump, reserves can deteriorate, meaning the claim jar isn't as full as expected. Now the scary twist. Prices can rise even if nothing new happens. In 2024, vehicle repair costs rose 65% faster than broader service inflation, pushing auto insurers to hike rates by double digits. There's also social inflation, when lawsuit costs rise faster than regular prices. It's like the courtroom becoming a multiplier that turns small claims into monsters. Verdicts over $10 million have tripled since 2020, creating big uncertainty for liability insurers. When the maximum loss feels unknown, prices rise or insurers leave. Third-party litigation funding can pour money into more lawsuits. Bigger verdicts can attract more funding, which can fuel even more lawsuits, a feedback loop. Reinsurers can retreat from uncapped liability risk, raising prices or reducing capacity. That pressure often rolls downhill to primary insurers and to your premium. And this is why lawsuits can hit your premium like a hammer. Insurers respond with micro-reform, tighter language, exclusions, and bigger deductibles so customers keep more risk. Add climate-driven disasters, and some regions become hard to insure at affordable prices. When insurers withdraw, state-backed pools often step in, shifting costs across taxpayers or all policyholders. That creates a quiet wealth transfer across geography. Low-risk places can stay cheaper, while high-risk homeowners pay more or rely on last-resort coverage. Insurance can also create moral hazard, meaning people take bigger risks because they feel protected. If everyone keeps rebuilding in unsafe zones, society can pay for the same disaster again and again. Some policymakers discuss linking insurance availability to risk reduction, like stronger building codes in hurricane zones. The idea is simple. Fewer losses means less pressure on premiums. Final turn, regulators are trying to close a loophole. A rated yacht feeder can change capital charges from about 30% to about 1 to 2%, like forcing a thinner safety cushion. The note gets an investment-grade label, so it can look safer on paper. Critics worry the risk underneath can still act like equity, even if it's wearing a bond costume. The NAIC has been cracking down, proposing higher capital charges for complex assets like CLOs to reduce regulatory arbitrage. Regulatory arbitrage is rule shopping, finding the cheapest rule for the same risk. The market may split into giants and specialists, with the middle getting squeezed. Big carriers cherry-pick customers, while specialists take hard risks at much higher prices. Zoom out, and your premium doesn't just sit in a vault. It gets recycled into the economy through bonds and loans. Over half of U.S. corporate bond funding comes from insurance and pension investors. So next time you pay a premium, you'll know what's really happening. You're buying protection and feeding a two-part machine that tries to win on pricing, win on investing, and stay safe enough to pay.